It's a very sobering experience when you realize not only could you maybe avoid paying 10, 12, 15, $20,000 a year in taxes, you're also decreasing your healthcare costs. Welcome to the Retire on Time Q&A podcast. I'm Michael Decker here with David Franson from Kedrick Wealth. As always, this podcast is really about answering your questions, not the oversimplified advice that you've heard hundreds of times. We want to answer the questions and give you more context and clarity than maybe you'd usually get. That said, remember, this is just a show. It's not financial advice. Keep doing your research. Now, you can always text your questions to 913-363 and we'll feature them on the show. First come, first serve, and let's just see what we got. David, what do we got today?
Hey, Mike, I'm having a hard time understanding how income planning affects healthcare planning. Can you elaborate?
So you have this kind of intersection of planning that a lot of people will miss. And the reason I think is what people are most concerned of is where they will favor. So your income planning is going to affect your tax planning. Your tax planning is going to affect how much income you need from your portfolio. Do you see how those two intersect?
Yeah. So if I take more income than I have, I pay more in taxes.
Maybe.
Okay.
But I mean, if you take your income, let's say 1 year from a brokerage account and you only realize long-term capital gains,
Oh,
the 0% long-term capital gains bracket is rather forgiving
uh,
and you're only paying taxes on the basis. So that 1 year, you might actually need to take less from your portfolio because no taxes would be paid. That's a 20% difference on your distribution, roughly speaking, for that year, potentially at least.
ah,
And so you've got these two variables.
mm-hmm.
It's like whack-a-mole. You hit one, then the other one pops up and you have to kind of move it around. And that's just income and taxes. And then you bring in healthcare planning. Healthcare oftentimes is heavily influenced by your modified adjusted gross income. So that's not just how much you took in there. It's not just your standard deduction. The modified adjusted gross income is going to affect other parts. So you have to kind of consider other aspects of it. And if you can do your income planning seasonally and your tax planning seasonally, you may be able to have a lower healthcare cost for Affordable Care Act, at least if you're before 65 years old. And then after 65 years old, you may want to strategically limit your IRA distributions or your IRA to Roth conversions for tax planning purposes so that you don't trigger IRMA, which is the post 65-year-old situation where you're paying extra in healthcare premiums. Maybe you're just stuck with IRMA and you just have to pay it. So now it's mitigating the benefits and detriments of how much IRMA you're going to pay versus the IRA to Roth conversions versus your income and so on. But it is, you can't separate these different aspects. And then Social Security is another, you know, part of the whole conversation they have to consider as well. If you turn on Social Security, that's a tax efficient income stream, but that might get in the way of your IRA to Roth conversions and it might triggers. And so it all comes together.
Yeah.
Okay. So what was the question again?
Yeah. So the
I kind of went,
question,
that's the premise of this healthcare question.
set the stage here. Lots of different things to consider, lots of acronyms just mentioned by you. So how does income planning affect healthcare planning? And so under the healthcare planning like heading here, what falls underneath that? What is healthcare planning? What costs are we talking about when we talk about healthcare
So
costs?
I'm assuming that this is talking about your health insurance.
Okay.
So Affordable Care Act health insurance before 65, Medicare afterwards. It could talk about long-term care insurance planning, hedging against future healthcare expenses and so on, because Medicare doesn't cover long-term care. Really. I mean, there,
Mm-hmm.
there are some things that Medicare will cover, and I'm going to leave it very generic because those things change often.
Uh,
Medicaid's its own thing as well, but generally speaking, long-term care or certain medical expenses you'll be paying out of pocket. So let's do that one second. Let's first do the normal health insurance.
all right.
Seeing a doctor, you break your leg or whatever. Okay. So the reason why I think this is important and why they do really influence each other is because many people want the simple, just turn on their income streams and call it good.
Yeah.
And so you're going to see someone that says, I'm going to retire at 64 years old or 63 years old. So I'm going to turn on Social Security then, just so I have an income stream coming in. I'm going to then take X amount from my portfolio and I'm going to split it between my IRA and my brokerage and whatever. Maybe it's just IRA, maybe it's IRA and brokerage. And that's kind of it. They might say, well, I'm going to leave this much money for long term growth, but I'm going to buy an annuity So at 63 or 64 years old, when I turn on my Social Security benefits, I'm also going to turn on lifetime income from an annuity, which isn't bad. It's just a tool.
Mm-hmm.
But you can't do much tax planning. You can't do many adjustments when you just retire and turn on these income streams. They're kind of a rigid, formulaic structure. And whenever you have rigidity, you lack the flexibility to implement other strategies.
Okay.
So, what if, for example, someone decided they wanted to retire at 63 years old?
All right.
And instead of turning on Social Security at 63, instead of turning on their IRA distribution at 63, what if they turned both of those on at 65 and they had enough in their brokerage account that for those years 63 and 64 years old,
Mm-hmm.
they took it all from a brokerage account? Here's kind of what you could be getting. You could take it from, let's say the markets are up, so you're taking it from stocks. Like, you bought Apple forever ago,
Okay.
and there's a low basis, so it's hard to get it out tax free. Well, maybe you just sell the Apple, and the basis is below the 0% tax bracket. Look up how capital gains work. Ask your favorite AI, Claude, ChatGPT, Grok, Gemini. Have I missed any? Does DuckDuckGo have their own AI yet?
I think they use chat GPTs, but yeah. You
Whoever
got all
it
the big
is,
players. Yeah.
But ask them how long-term capital gains work, and even go to retireontime.com, okay,
Mm-hmm.
and go to the tax planning calculator and play with it. It's a very sobering experience when you realize that not only could you maybe avoid paying 10, 12, 15, $20,000 a year in taxes, let's say,
Mm-hmm.
which is a savings, that leaves more money in your portfolio to grow. Okay, so more money in your portfolio, it grows. There's a compounding effect in your favor,
Yeah.
but you're also, because you structured those 2 years to be income in a very specific way, you're also decreasing your healthcare costs. So instead of paying whatever it ends up being $6,000, $7,000, or whatever it ends up being in your state for your situation in the Affordable Care Act you want, you might pay $7,000 less that year, which means you
Oh.
need to take less income, or you're just going to spend more in different ways, maybe for travel or whatever it is. So not only are you lowering your tax bill because you did income tax and healthcare planning correctly, but you're also lowering your healthcare bill because you did income tax and healthcare planning correctly.
Oh, and how did they lower their healthcare bill? I may have
So
missed that.
yeah, it's the subsidies.
Oh, okay. Yes.
So
Yes.
the super subsidies have gone away,
Uh-huh.
but the original subsidies, if you're within the 400% of the federal poverty line, so it's like around $86,000 for a couple kind of a situation or somewhere around there.
Okay.
The numbers keep changing, so this is a video, so do your research, find
Yeah.
the updated information. Don't go off of this. But if your income, not your effective tax rate
All right.
income, right?
Yeah.
It's based on your modified adjusted gross income. But if that is within a certain threshold, you could get some subsidies, which means you're paying less.
Yeah. Basically, this is what the premium would be. You apply the subsidy, and now your premium is only this much. It's
Yeah, I mean, it could be very,
yeah,
very cheap.
significant. It could be up to half off or more
So
or less.
yeah, it's a deal.
It's a good deal.
It's a good deal.
Yeah.
So the
We like deals.
yeah
Deals with a Z too.
yeah, my 3 Z's.
Yeah. 3 Z's in this case too.
That's extra good.
Yeah.
But so do you see how we're lowering tax bills, we're lowering healthcare costs, and we're retiring earlier because we had multiple layers of planning and strategy implemented.
Right.
And we didn't use the income stream options. We had kind of 1-year bucket, 2-year buckets to realize those funds, access to those funds while everything else was able to grow.
Mm-hmm.
So it's this kind of coordination that can make a really big difference. Now, you might say, okay, well, let's say I do that. How do I get the money? The subsidies.
Oh yeah.
There's really 2 ways you could take it. One is you could just tell the government, say, hey, this is what I expect my modified adjusted gross income to be this
Right.
year, and then they can lower the premiums. And if you're right, then you're good to go. If you're wrong, you're going to pay.
Yeah. You'll have to pay them all back.
Or you could just wait until you file your taxes, and then you would get the tax credits or the refunds, or you can use them as you see fit.
Oh, right. Right.
So it's not like you can do this and, ooh, I forgot to tell someone. It shows up.
Mm-hmm.
The tax return's kind of the gatekeeper of payday or pay up day.
Yes.
Just made that up. That was good.
Yeah. Pretty good.
But so that's how it works when it comes to Affordable Care Act planning.
Hmm.
Medicare, whether it's Medigap, Meta, or Advantage plans or traditional Medicare, that's more of just what kind of coverage do you want. They're all pretty affordable. You pay
Hmm.
for what you get for. So if you want extra coverage, you go to a Medigap plan. Don't think Advantage plans are going to solve everything. They're not.
Hmm.
They're just a different way to slice and dice the same thing.
Right.
You're not cheating healthcare with Advantage plans. But that leads to the next conversation of long-term care insurance, additional healthcare costs that may not be covered by your traditional senior healthcare benefits.
Okay.
And in that situation, you have to ask yourself, okay, well, where would I access the funds later on? And then how would that disrupt other parts of my plan? So you might say, I want to fund a long-term care policy. I want to fund life insurance and then access the death benefit if you qualify. Or maybe you're just, more old school, like I see more often than not, where maybe if you needed something, you would just spend money from a brokerage account, utilizing long-term capital gains, or you'd spend it from your Roth because that doesn't disrupt your income planning and your tax planning with all of that. So just kind of understand the different seasons before 65, between 65 and 80, and then after 80 when a lot of the expenses typically creep up. And how do you want to pay for it? Where's the income going to come from? How do you access those funds? How are they going to affect your taxes? It's a nuanced, multi-layered problem, and these conversations need to happen.
Right.
Do you think we answered it?
I think we did answer it, and you can talk with someone like us here at Kedrick Wealth. You can have a conversation with prompts and the AI, and just prompt the heck out of the thing too. Like push back on it, question it. Right.
One of my favorite prompts is, what questions am I not asking
Mm,
that would lead to a conversation that may change my opinion? Or you could say, what don't I know that would change my opinion?
yeah.
And it might be like, oh, that's an interesting fact, but my opinion still stays the same. Or it might be that my opinion's now changed. AI is not trying to sell you anything.
Right.
It just wants to give you good information so you keep paying that subscription.
Yeah.
Or maybe you're doing the free version. I don't know. But
Yeah.
but that's a beauty. It's a benefit of AI. The detriment is it can hallucinate. It
Mm,
can misquote tax law. It can, it's still not perfect. It's getting really, really good.
yeah.
But just be careful that you may not ask all the right questions. It's a great starting place. It's a great place to confirm what you're being told, but it may not yet be everything that you need. And there's an emotional aspect to it too that you want to consider because the markets just don't make 6% every single year or 7% every year. They're going to go up and they're down. There's going to be other factors that you'll need to consider in the holistic side of your retirement plan. So that's all the time we've got for this question. If you enjoyed the question, don't forget to like and subscribe to the channel or wherever you get your podcasts. Lastly, I want to invite you to either download the book, retireontime.com. You can grab a copy of the book, the workbook, the AI prompt list, and the checklist, or attend one of our workshops where we actually build plans live and answer your questions along the way. All of that's available by going to retireontime.com. We'll see you in the next show.